This is a short video on the coronavirus and policy. Part 1, money. If you saw my other videos, you know that an economy is maintained by individuals trading and sharing with each other. Each person or individual or business sells something and gets cash or money in exchange and uses that money to pay for something else. I teach at a university. That university sells those courses to students who pay the university money. That university then pays me money. I then take that money and I pay for my house and I pay for food. That store where I paid for my food uses that money to pay workers who then use that money to buy food themselves, and so on and so forth. So we have to account for the total GDP that's being sustained by this constant percolation of activity. So we need enough money times how many times it changes hands, that's velocity, to finance GDP that would naturally be occurring. In the US, the velocity of money for basic money from M1 is about 5. So if the GDP is $100 of activity a week, we need $20 times 5, changing hands 5 times to finance that $100. Okay, 20 times 5 is 100. So too little money, and there's not enough cash to allow that system to just keep turning. So when this cash gets short, the university doesn't have, the students don't have money to give the university, which means the university doesn't have extra money to give me, which means I don't have money to pay my bills, which means the store doesn't get its money either. Or I get half my money and I pay half my bills in the store. So that can all depress economic activity if you put in too little money. So we also learned that putting in too much money may feel good at the beginning, but only leads to inflation in the long run. So there are 2 key things to understand here before we start. 1, the amount of money needs to be in the system to support the naturally occurring GDP. 2, in the short run, if you increase the money supply beyond that, you might get a boost in GDP temporarily, but eventually it only transfers and translates into higher prices, which is higher inflation. So keeping those 2 things in mind, the coronavirus in this regard did 2 things, and I'm going to treat them separately. Virus. 1, social distancing greatly reduced velocity. Velocity dropped tremendously. I am not out trading and going to stores as much as I used to. I still buy some things online, but the velocity of money shrank dramatically when we all social distanced. As a result, therefore, one thing the Fed must do in the United States and central banks in other countries, they must increase money just to offset this and try to maintain the natural level of GDP in the economy. So first they have to inject extra cash just because it's not changing hands as much, so that everybody who does need to buy or sell has cash available to do it. So that's a drop in velocity that they just need to increase liquidity in the system. The second thing is social distancing, but also closing all of the shops has left a drop in labor, which means every single business is producing less, which means real GDP slowed way down. Production dropped. Consumers bought less, which means companies also produced less, but the labor effect also reduces output. So this happens for 2 reasons. 1, the reduction of labor, and 2B, if you like, the reduction in consumption demand. Both of those pull real GDP down. now we come back to this. And I'll put it in blue. That means also GDP is dropping because of this second effect. Okay? And we'll call this one the first effect, the social distancing effect. In a crisis, the Fed knows extra money can help boost GDP in the short run. So, in addition to the money just to offset velocity, to help maintain the economy, as GDP drops, they will go for this to get extra GDP, even if it's only for the short run. The short run can last 6 to 8 to 18 months before it just feeds into the prices. So they're more than willing to put extra money out there in order to falsely boost GDP to offset some of this. So they will also increase the money supply to offset that as well. So this is also an increase in M to boost Y, which is falling itself. One problem. I explained in a video that GDP is fundamentally produced by labor, capital, technology. So this may help a little bit boost some of the demand and the consumption, but it's not fundamentally putting employees into jobs. So it's not going to have as big an effect as it would normally. Normally they do this just to boost consumption. If you go back to the video where I showed the mechanism, the first effect was people went out to consume more, and that boosted demand. The problem here, and that's why I put it first, is a drop in the labor working at companies too. And as a result, this effect on the boosting output will be much smaller. You'll see that in statements by the Fed that is explaining their primary goal is maintaining liquidity in the system today in order to maintain the system and the constant turning of cash in the economy to maintain GDP. It's been left up more to fiscal policy, which is the government spending and stimulus packages, to help boost this GDP in the short run. I hope that helps.